All right. Good morning, everybody, and welcome to Renting and Home Buying. This J-term session, I think, was really important for me to present to you all just because I think it's a very confusing process. So as I mentioned, if you have any questions, please feel free to put them in the chat. Please feel free to email me, anything along those lines. I am happy to help where I am able to help. For those of you who don't know me, I am Paige Cook. I am the Associate Director of Student Activities and Greek Life here at Gettysburg College. I know I see some familiar names, so I definitely recognize some of you, but for those of you who I haven't met, that is a little bit about me. And I do like to point that out because I'm not an expert in this field. I'll get into this a little bit more in just a second. So right before we get, kind of launched into that, I wanted to give you an outline. So we're going to look a little bit at the difference between renting and home buying. We are talking about that a lot, but I do recognize that as we kind of navigate these spaces, a lot of you may be seniors or juniors who are kind of prepping for, what comes next, where you're going to live, are you going to move out, all of those different things. But I also want to totally normalize that it is fine to live at home for a little bit after college to save up for some of these things. So do not feel bad about that, but this is just to kind of give you some of those tips as you're looking at what is the best course of action for you as an individual, or you with a partner, if you have a partner, any of those different things. So we will be talking about those differences. We'll be talking about the benefits and the drawbacks of renting, as well as the benefits and drawbacks of home buying. We'll also talk about some considerations for rentals, some things that you really need to know when you are diving into the house buying process, what the different types of mortgages that exist out there are, and then kind of just an outline of what the actual I want to buy a house process is. The last thing I'll give you is just a little more, just extra things to keep in mind. But again, this is not an all-inclusive session. I only have an hour with you today. There is way more that I could talk about if I had more time. But again, I want to be respectful of your time, and everybody's situation is different. So if you find that, when I'm talking about buying a house and that's just totally out of your sphere and you're just not ready to think about that yet, and you want to pop off the call after we stop talking about renting, that is also totally fine, because everybody is in a different situation and you have to do what's best for you. So as I mentioned, I am not an expert. I work in student activities and Greek life. I do not work in real estate. I am not a realtor, but I have rented before, and now I do own a house. And it was so confusing for me when I was going through that process to buy a house that, again, that is why I wanted to give this session to you. So I do want to lead with that. I do want to own the fact that this is not, my career path. This is not what I, know the true nitty gritty of, but these are just kind of guidelines, things to keep in mind as you're beginning this journey for yourself. So that way, at least you're a little bit more informed than I was, at least. And then hopefully you can kind of jump into this process and say, oh yeah, I remember this. This is not completely new information. This is not shocking to me. But it still may be a little difficult to navigate, but at least you're not completely in the dark with that. So that is really where this session was born. Again, feel free to ask me questions, but know that I may not know everything. So the first thing you have to do really as you are kind of navigating renting versus home buying is really figuring out, like I said, what's the best option for you. So everyone has a different path. It gets really easy to kind of say, oh my gosh, I'm this age and I can't believe that, my friend or this person I went to college with or whoever is already buying a house or already doing this. You are in a different situation than that person. I recently had this conversation with a friend of mine where, she was saying it's been really disheartening for her and her husband to not have been able to buy a house yet. But their situation is completely different than my situation. And we sort of talked through those different things. So try not to compare yourself to others. Try not to do the, by the time I'm XYZ age, I will have all of these things accomplished. It is a great goal to work towards, but if you don't meet that goal, just know that that is totally normal and that is okay. So my big rule of thumb as you're sort of mapping out what is the best for you is, again, if you want to stay, living in your current living situation, whether that's at home, whether that may already be in an apartment where you have roommates or things like that, just to save up money or just to kind of figure out what's the next step. What city are you moving to? How long are you going to be there? All of those different things you should take into consideration. So if you are looking to kind of be transient, in that you want to move after a year, maybe 2 years, you're really not in a location for long, you probably want to rent. I know I've had some conversations with students recently where they know their appointment at the job that they've been offered after graduation is a 2-year position. And so does it make sense to buy a house in that area if you know you're only going to be in that position for 2 years? Now, you may stay at the company, you may stay in that area, or at least know that that's where you want to be. And if that's the case and you want to stay for usually 5 or more years is what they kind of give you as a guideline, then home ownership may be the best path. And so we'll talk a little bit more about why those are the best paths as far as timelines and kind of how long you're staying in an area. But do keep that in mind as you sort of navigate which option you would like to pursue. So the benefits of renting, as I kind of just reviewed a second ago, was the flexibility. So the upside of renting your apartment or home is that if you don't like the space that you're living in, you get to move out. Right? A lot of places do have 1-year leases. I think that's what you hear most often and most commonly is, you enter a lease with your landlord, you have that for 1 year. What I always recommend is kind of looking at the actual content of your lease agreement. I know a lot of times we kind of gloss over, the terms and conditions of various things, whether that's signing up for a new email account or Spotify account or whatever the case may be, but really do look at the, in-depth pieces of information of your lease, any rental agreements that you have, because those can also help you navigate what your flexibility with that lease is. So whether it's a year long or whether it's less or more, how much it will impact you if you were to break that lease is really important to know. So for example, I rented a property, I decided I wanted to buy another house. I ended up having to break my lease for my apartment early so that I didn't have to double pay my mortgage and my rent at the same time. And thankfully, I had a landlord that was very understanding. He worked with me on that, and it didn't penalize me in any way. But there are landlords, there are places that will charge you extra to break your lease. So you kind of have to navigate, do I want to pay rent for another month, or do I want to pay this fee to get out of my lease early? And so that may just depend on where you are in that lease. If you still have 6 months left, do you want to pay for 6 months? Do you want to sublet? Do you want to do all those different things? Or do you want to take the one-time $500 charge, for example? So you want to kind of navigate those things, but I do also know that there are a lot of landlords out there, especially after you've leased for a year, that may change the terms of your lease to be month by month, which gives you extra flexibility, because if you decide, oh yeah, I want to be here, you just keep re-upping your lease. But if you decide, oh, at the end of the month, I want to move to this other property, I can do that really easily, no big deal. So make sure you are looking at all those terms. But again, if you are only staying in a place for a year or two, the flexibility of renting is really going to be in your favor. The other big benefit of renting is maintenance. If you are not a particularly handy person, you don't know how to fix the big stuff, renting may be a really good option for you. Your landlord is going to cover a lot of maintenance for your property. If something big breaks, if there's a leak in the roof, all of those different things, that is going to be covered by your landlord. So it's not going to have to be something that you are paying necessarily out of pocket. The other really big benefit of renting, of course, is that you require less money up front. So a lot of properties will give you what the rent is, may require an extra month of rent and a security deposit. But paying essentially 2 months of rent and a security deposit is usually a lot more attainable than going for a down payment and going through all of the closing costs and things like that associated with home buying. So it does require a lot less money upfront. And again, different landlords will require different things. So some may require the deposits and an extra month. Some may just require a deposit. It just depends on the property that you're looking at. On the opposite side of things, there are a lot of drawbacks of renting. And I'm sure that you guys, if you've been living in residence halls, are kind of familiar with some of these drawbacks, such as the customization limitations. Just as in your residence halls, a lot of apartments and houses that you'll rent, you can't paint the walls, you can't put holes in the walls, you can't really make it your space in the same way that you would be able to with a house. So that is a limitation that comes along with renting, is again, that ability to put up artwork, to knock down a wall if the layout isn't what you want or anything like that. You're not really able to do that with renting most times. The other big drawbacks include pet policies. So a lot of properties do have pet policies or do not allow pets at all. And so again, just really make sure that you're checking those out, especially if you already own a pet and you want to keep that pet as you look at properties wherever you are going to end up next. Make sure that you are keeping those pet policies in mind. Renting does cost more money in the long run. So you save that money kind of upfront, but in the long run, renting often costs more than your mortgage, which seems a little weird. And then the other piece is in that same line is that your rent can kind of change from year to year. So again, at the end of your lease, you may want to stay in that property. Your landlord may draw up another lease for you and your rent may go up by $100 or $200. So there is kind of that fluctuation in rent cost. You may pay more for a property than you would for a mortgage for the same type of property. And then the last piece is that you're not building home equity. So all of those last three kind of go hand in hand. To dive a little bit deeper into home equity, I think that's really important. So your home equity is your home value minus the principal owed is your home equity. So if you bought your house for $200,000 and you still owe $150, your home equity is $50,000. It's important to look at the principal, not including the interest or anything like that. But if you're looking at that, you now have this home equity, this difference between how much your house has been valued at and how much you still owe is basically what you have earned. So you can take that equity and it can help you with loans. It can help you with the big stuff. So when you want to do a new roof, if you want to install a fence, if you want to get a car, it doesn't have to necessarily be home related. That's where equity comes into play. With rental properties, you're not building any of that equity. You're essentially paying your landlord. Your landlord is paying off the mortgage, so on and so forth, or they're pocketing the money. And so that's how it kind of costs you more in the long run, because you're not essentially putting money into this extra equity that can help you down the line. So it's just kind of where your money is placed at the time. When you're renting, you're not really gaining anything. It just kind of disappears into space. When you buy, you're building these home equities and things like that. So that is definitely a drawback of renting. The other thing I just want to highlight, as you are looking at rental properties, again, pay attention to what's required of you for maintenance. So the big stuff is going to be covered, like I said, right? If you get a leak in the roof or your water heater breaks or something like that, that is not on you. Your landlord is going to be covering that, or they may have a maintenance team that handles that, all of those different things. Again, look through your lease, understand your lease before you sign it so that you know exactly what they're covering and what they count as the big stuff. But also pay attention to the small stuff, because I think that comes and, sometimes you think, oh, I'm renting a property, I don't have to worry about this other maintenance, but you still do. And so in those situations, you are really looking at, does your landlord require you to mow your own lawn? Do you have to shovel the snow, right? If you're living in an apartment building in the city, probably not, right? You might not have a lawn. You might not have to worry about snow because somebody else does it. But if you're in a rural place like Gettysburg, Pennsylvania, for example, that is a requirement that some landlords have, especially if they don't live local. Those are things that you may have to take on. So just be aware of that, and then also ask questions, right? My former property that I rented, I had to mow my own lawn, shovel my own snow, all of those different things. But my landlord included a mower. He pretty much said, yes, you have to mow the lawn, you are responsible for it, but you don't have to go out and buy this piece of equipment. Some landlords might request that you buy your own equipment. So know before you get into it, if you have to mow your own lawn, do you have to buy your own lawnmower? Do you have to do all these different things? Because those are different added expenses that you may not have realized would have been added to your total cost at the end. The other thing, again, going back to pet policies, a lot of places have limitations on pets. Me, if you know me, you know that I am a cat person. I have 4 cats now, but 2 of them are my fiance's, but the 2 that I had prior to, my current relationship, I had to hunt all over the place to find places that would accept 2 cats. And so that is something to be really aware of as you're looking at pet policies. How many animals do they accept? Do they accept all kinds of animals? Do they have restrictions? Some apartments are dog-only apartments. Some require just cats. Some have breed restrictions. So if you do have a dog, they may have a restriction against certain breeds. They may also have a weight limit. So a lot of places are like small dogs, only 40 pounds or less, so on and so forth. So make sure that you're investigating all of those different things. Again, especially if you already have a pet, but if you are looking to get a pet down the line, that's really important to know as well. What are those restrictions? The other thing to keep in mind is, again, these additional costs you might not think of ahead of time. So a lot of landlords do require a pet deposit, and some also require a monthly pet fee. So make sure you know that before you go in. A lot of pet deposits range from $200 to $300. They may go higher than that. And you will pay that up front. But again, I know for me and for some of my friends, you have to pay a monthly pet deposit as well, a monthly pet fee. So you may be looking at an additional $30, $50, something like that per month, depending on how many animals and what type of animals. Switching gears a little bit, there are a lot of benefits to buying your own home. So the upside of becoming a homeowner is it costs you less in the long run. So like I said before, one of the drawbacks for renting is your money just kind of goes and it doesn't go anywhere. It goes into the pocket of your landlord. When you are buying, you're building that equity. You are also paying less in the long run, most likely. So I know that now as a homeowner with a bigger house than my apartment, I pay less in my mortgage per month than I did in my rent at my old apartment. So that's really important to keep in mind. And that is the case for a lot of locations. So in the long run, you might be spending less overall. You also get tax deductions. So because interest is related to your home buying process, and because there is an interest rate on your mortgage loan, you do get to deduct that when you do your annual taxes. So that is something that can benefit you when it comes time for tax returns in April, and you can get more money back in your tax return because you are a homeowner. So that's a really cool thing. Again, it builds that home equity. So your money is not just disappearing, it's kind of being offset so that later, if you need it, you can take it. Or when you go to sell your house, you net that profit, right? So that's kind of the benefit of that. And then the last thing is the customization. So always keep in mind borough ordinances or town ordinances, all of those different things, because there are some limitations, of course. If you are doing a major piece of construction, you're probably going to have to get approval for some of those things. If you're, adding a shed to your backyard, some, boroughs and townships require certain zoning permits and things like that. But for the most part, in all intents and purposes, you are able to customize your property really to how you want it to be. So you can knock down that wall as long as it's not a load-bearing wall in your house. You can paint the walls whatever color you want, put up as many pictures as you want, and kind of make it your own living space. And so that is one of the really nice things to, make your home a home. One of the drawbacks of buying is, again, that less mobility. You're kind of stuck. And so one of the things that's really important to notice is you can buy a house and you can sell it, you know, a year later or 2 years later. But when you do that, you are looking at pretty much just having paid interest on your originated loan. So you get your principal and you get your interest payments. In those first few years, roughly 5 years, you're really just paying down interest. You're not really paying much to the principal, so you're not really building that home equity yet. And so that's why it's a better option for you if you're staying in an area for longer, so that way you're not kind of putting yourself into a tricky situation with that. One of the other drawbacks of buying is, of course, that maintenance, right? The same stuff I talked about the landlord having to handle, the big stuff, that is now on you. And so keeping that in mind as far as, you know, what happens if your roof leaks? What happens if, you know, your foundation cracks, things like that, your water heater breaks, all of these different things are now on you. And so some of them may be really easy fixes. You can call a plumber super easily. They can fix your toilet. It's all good. And then again, you have some of those bigger things that may be very expensive fixes. And so just keeping those in mind as you kind of navigate buying a house. And then, of course, the last one is that you do require more money up front. So you're going to have to worry about closing costs, your down payment, all of those different things. And so you will need a little bit more revenue when you're going into that process than if you were renting and you only had to worry about 1.5 months of rent. So kind of going in that same vein, your closing costs are those fees that your lender, so your mortgage lender, the person who's going to give you a mortgage loan, as well as other parties, will charge you to originate that mortgage. So you will have a real estate fee, right? Your realtor will charge you a fee for their services or a commission for their services. Your insurance agencies may charge you for that. Your lender is going to charge you for that. And so those closing costs can end up costing 3 to 6% of your home's final purchase price, because again, real estate, you get a commission. It's based off of how much the home is valued at, all of those different things. So be mindful of that, right? I think that one was a huge shock to me going into this, because everybody talks about down payments. And I knew I had to have my certain down payment. And then, you go through this whole process, you get to that kind of final step where you're closing. And then all of a sudden you're like, oh my gosh, I have to come up with how many extra thousands of dollars. And so keeping those in mind as you're beginning the process is going to be super helpful for you, so that you don't have kind of that sticker shock at the end. And then your down payment, of course, we always hear kind of this 20% number, at least, in media or movies and things like that. And, if you watch HGTV, I'm sure you've heard it 1,000 times. But down payments are not always required at that level, so they are usually required. Lenders do like you to pay a certain percentage of your house's overall cost, but it's not necessarily as, high of a percentage as, you may be thinking. It may be none, and we'll get to that later, depending on what type of loan you get, or something as low as 3%. And so again, just making sure that you're thinking about those things as you are approaching this process. And this is again why I say renting may be a great option, living at home may be a great option for a little bit, because again, my example of a $200,000 house is a 3% rate on that $200,000 house is going to cost you $6,000. So keeping that in mind as you are moving forward, $6,000 may seem like not too much for some people. It may seem like a huge amount for other people. So again, just making sure you know what the best options are for you. I have a little clip for you. If you're Gilmore Girls fans, you may know this.
What? I am an Escrow. I got the paperwork approved. What are you talking about?
We bought a house.
What? You just started looking.
I know, we bought the first home we saw.
Oh,
No, I'm telling you, I walked into this place and just felt it.
felt what?
The vibe.
That's right. She felt the vibe, and now I'm in Escrow. Did you at least have an inspector look at this place? Hey, we don't need some guy with a clipboard to tell us what we already knew, which was this White House was for us.
Please don't be worried about this. The place is great.
It's on a corner corner. It's got room for a pool. It's air conditioner ready. It's landscaper ready. It's alarm ready. And it's got 3 bedrooms if you build on it too. It's got a roof, right? Of course it's got a roof. But as soon as we replace it, it won't leak as much.
Just be happy, okay?
Oh, sure. That's right, buddy. Smile, man, because I'm in Escrow. Coffee on the house. You like that on the house? You're paying for coffee for the entire time. What, am I made of money? I'm in Escrow. Throw in the coffee, buddy. We're celebrating.
Got it. You're really bug removing here, are you?
Does he even know what Escrow means?
I doubt it, but it's so happy.
I'm in Escrow. Give it up, sister. I'm in Escrow.
All right. So I'm a big Gilmore Girls fan. I always think of that clip when I talk about escrow, and so I needed to embed it here. But escrow is really important to understand as well, because most mortgages are going to require that you also have an escrow account, which is a legal arrangement between a third party, which temporarily holds your money pretty much until you can until you pay off your loan, essentially. And so there are 2 types of escrow accounts that you may encounter. So one is sort of during the home buying process, and they may take a certain amount of money. So usually around $1,000 or maybe $2,000. It depends on kind of the value of your property to originally set up your escrow account. And so what they essentially do is it's kind of like, a deposit, if you will, in that sense, in that situation where you're giving them $1,000, which essentially says, I'm really interested in this process and I'm going to make my interest more well known by saying, yes, here's $1,000 that you can hold on to and add to my escrow account. Because if you move forward with the loan, that $1,000 doesn't just disappear, it does go into your escrow account, but it essentially verifies that you're a little bit more serious about the process, and it gives the lender a little bit more protection. And so that way they know you're not just going to dip out because you now have put some money into the process. You are a little bit more invested already. So that's the first type of escrow account that you may encounter. The second type of escrow account that you may encounter is the one that's going to pay for your taxes and your insurance. So again, you're essentially paying into this escrow account and they just hold your money, and then your escrow account pays for those things. So you will get your taxes billed to you. You will have to pay for homeowners insurance, all of those different things. But rather than scrambling in that moment to pay off those thousands of dollars in taxes or insurance, it's built in as a monthly payment along with your principal and your interest for your mortgage payment. So that way, when you get to that point, you can, you're paying maybe $200, $300, whatever into your escrow account a month. And then when it comes billing time for your taxes, which usually happen twice a year, your escrow account is just signing that check for those thousands of dollars based off of the money that they've already collected from you monthly. And so that's kind of where escrow is helpful, because again, you don't have to come up with all that money up front. You are building it, and then sometimes they give you money back if they've overcharged you, so on and so forth. And so they really handle a lot of those taxes and insurance. But again, it's really important to remember that you will have an escrow account most likely, because you're not just paying, again, the principal and interest of your loan. You are paying principal, interest, monthly payments, and your monthly payment for your escrow in a lot of cases. The other piece, again, insurance. So taxes are one piece of your escrow, but your insurance is also a big piece of your escrow. Or if you are a renter, it's also really good to look at insurance. So for your home buying process, you are required to get insurance. Lenders most likely will not give you a mortgage or will not approve a mortgage for you if you don't have insurance. So it does pay for the big things, right? Natural disasters are a big one, as well as robberies. If somebody breaks into your house, steals your items, anything gets lost or damaged or stolen, this is what's going to help protect you, that insurance there. Similarly, if there is a hurricane or something that destroys your property, your homeowner's insurance is going to be able to help you out with that and get you back up and running after one of these situations happens. On the other side, renter's insurance may be required by your landlord. It may not be, but if it's not required by your landlord, it's still a really good idea to get insurance. And again, that's just because it protects you in the long run. So again, if your items have been stolen, damaged, destroyed, if there's a roof leak or anything like that, your landlord's going to be handling that on the homeowner's insurance side, but that may not necessarily pay out to you. So if you're renting and you have very valuable electronics or things like that that you're concerned about getting damaged, get renter's insurance so that way you know if something happens, if one of those things is damaged or stolen, you are going to be able to work with your insurance company to replace those items or repair them. So drilling into the home buying process a little bit more, there are some really important numbers that you need to know going into home buying. Your credit score is going to be one of the most important numbers to think about. So your FICO score is a 3-digit number. Some of you may already know your credit score. Some of you may have never heard of a credit score before, but essentially your credit score is a snapshot of your financial decisions. Every person has 3 reports. So there's TransUnion, Experian, and Equifax that give these reports annually on each person. And they may have different numbers. So that's really important to recognize, is that if you think your credit score is this, it may be a little lower at one of the other agencies. It may be a little higher at one of the other agencies. And that's just because they collect different information. So some of them may be drilling a little bit more into all of your loans. Some of them may just be looking at sort of credit cards, things like that. And so you are really going to want to focus on all 3 of them as much as you can. The other thing that you're really going to want to look at is your debt to income ratio. And so this is another big thing that your mortgage lender is going to look at, because it looks at your total monthly debts in comparison to your gross monthly income. So your income before they take all the taxes and all of that stuff out. And then the last thing to keep in mind is, of course, how much money you can afford, how much you can afford in a payment. So if you get approved for a mortgage that's higher than what you're comfortable with, just keep that in mind. You don't have to spend up to that amount. You can, go for a property that's lower than what you were approved for. But it's really important to go into the house buying process with generally what you would be approved for or what you can afford. So going a little bit more in depth onto your credit score, the higher the score, the better. So your FICO score is going to range from 300 to 850. It is very rare for people to have it over an 800 for a credit score. But a credit score over 740 is usually considered excellent. And then anything below a 620 can usually limit you pretty significantly. So when they are generating credit scores, when they are looking at these, they are looking at a variety of things. So number one, and most important, is your payment history. So your credit score is going to be better if you consistently pay all of your bills, right? If you have credit cards out in your name, if you have student loans out or any other loans out, your payment history impacts you the most significantly with your credit score. If you don't have any of those accounts, you may also have a low credit score because you haven't shown that you have been able to build credit, if that makes sense. So number one, your payment history, make sure that you are paying all of your bills on time. It doesn't count like medical bills and things like that, because usually they don't collect that. So if you're paying your medical bill, you should still be doing that on time, but that's not necessarily being given to, Equifax or TransUnion or one of those agencies. The other things that are impactful are your number of open accounts. So as I, just mentioned, if you don't have any, that doesn't look very good for you. But if you have, a credit card, you have a student loan, you have those, a car payment even, those are all open accounts. And so that looks really good for you. So the more accounts you have, the better. And diversification of accounts matters as well. So again, if you have just credit cards and that's the only way you've been building credit, that's good. I mean, do that. But also if you do have a student loan or you do have a car payment or something like that, that actually bodes well for you because it shows that you are skilled at paying off different kinds of debts. So you're not just, good at paying off your credit cards, you're also good at paying your student loan payment. You're also good at doing these things. They are going to look at your credit utilization. So if you have a limit of $5,000 on one credit card and you are paying, and you have a balance of $4,000 on your $5,000 card, that's not going to look very great for you. They're going to look at the overall amount of credit lines that you have available and the overall amount that you can have on your credit cards. And then they're going to look at how much of that you're actually using. So keeping your balances low on your credit cards is super important in this process. The age of your accounts matters a lot too. So again, don't rush to open a zillion accounts right now because they're going to say, okay, all of your accounts are only, 5 months old. That doesn't look good for you. But if you can have, if you already have one, again, student loans, or maybe you got a credit card earlier, you are building that up. And once you get, more payments, more history with those accounts, that shows up better. The other thing that I really like to point out that I don't think people talk about very much are hard inquiries versus soft inquiries for your credit scores. And so when an agency does a hard inquiry, they report that out. And if you have too many hard inquiries back to back, that doesn't look good for your credit score. And they will be able to see that will make your credit score go down. And so where that comes into play is, you're making a bunch of big purchases back to back. If you are going and you're trying to buy a car or lease a car, they're going to make a hard inquiry for that, which means they're pulling your official credit reports, like the in-depth official credit reports. And when they do that, if you're doing that and then you're trying to buy a house back to back, that's going to be a little difficult because they're going to see that you had these hard inquiries right before you tried to make another one. So what I always recommend, and I think it's on my next slide, is doing some more of the soft inquiries on your own. So you generally know what your score is before you want to commit to one of these big purchases. The other thing to keep in mind, again, about your score in general, is that when lenders look at your score, the reason why a higher score is better is because a lower score is considered riskier. It makes you a riskier investment for that mortgage company. Because the lower your score, it probably means that you may not have made payments on time. You may not have built up any credit before. And so they don't really know that you're reliable at making those payments. They don't know that you're reliable at, just kind of what percentage of your credit you're using, all those different things. So usually that results in higher interest rates, which result in higher monthly payments because your lender is trying to protect themselves from the risky, the risk that they're taking with you because you have a lower score. The thing I was just mentioning about kind of soft inquiries is don't hesitate to find out what your scores are. Okay, so you are entitled to receive one of your official reports from TransUnion, Experian, or Equifax each year. So once per year, it is probably a good idea to do this. You can go on annualcreditreport.com and just order that, and they will send you those official reports from those 3 agencies. If you don't want to even go that in depth, I recommend a website like creditkarma.com. A lot of credit cards, a lot of banks, even if you look on the sidebars, usually it'll say did you check your credit score this week? And those are not hard inquiries. You can check them as often as you would like to, and it doesn't really hurt you. But that gives you, again, a general idea of where your credit score is. Me personally, I have Credit Karma, and I know that they email me all the time to tell me that my credit score has changed because, it's gone up by a point or down by a point based off of, again, credit card utilization, or I paid off a student loan and my credit score went down, which was confusing to me, but hey, that's the way the world works, because again, you're looking at that diversity of accounts as well as, you know, how many age, all of those different things. Lenders go off of the middle score of the person with the lower credit score. So this only comes into play if you're buying the property with another person. So when you are looking to purchase a house, maybe with a cosigner that is a parent, or maybe a spouse or a partner or whoever, the basis for your interest and whether or not you're approved is not going to go off of the better of the two parties. It's going to go off of the worst of the two parties involved in the purchase, or multiple parties involved in the purchase. And so again, TransUnion, Experian, and Equifax can report differently, and there may be a range of your credit scores. So they're going to pick the middle score of the person with the lower scores. So if your scores are 750, 735, and 700, and your partners are 650, 640, and 600, the number they're going off of when they're basing whether you qualify for a loan is that 640. So keep that in mind, because sometimes if, you know, the person you're trying to buy with, or yourself maybe even, has a lower score, it might be beneficial to buy the property on your own, or to or for them to buy it on their own. So keep that in mind. But what that then impacts is your debt to income ratio. So when you're buying with another person, their income counts as well when you're getting approved for your mortgage. And so if you are essentially saying your credit score is too low, I don't want you to be on this loan with me, then you are also taking away their income. And so you just have to find that balance too, because the debt to income ratio may then be too high for them to invest in you without that person. So it may be worth taking a higher interest rate or whatever if they are still going to approve you, even if the credit scores are low. So it's confusing. Navigate that if it's relevant to you. You may be looking to buy just on your own anyway, so it may not matter, but just keep those things in mind, is that these all have impacts on each other. The big thing to remember is that credit scores can change. So as you get your official credit reports, those ones that you can request each year, look for mistakes. This has happened to me where one of my credit cards was reported as being delinquent or whatever, and it wasn't. And so I had to get on the phone, I had to talk through all these people, I had to get it changed, I had to get it removed. And then my credit score shot right back up because of the mistake in the reporting. People are humans, they make mistakes. Sometimes those things happen. So if you're looking at your annual credit report and you're seeing, oh my gosh, my score went down by 40 points, make sure that it's a legitimate reason. If you forgot to pay your payment, I mean, they only report it after 30 days. So try and make it within 30 days, because that still doesn't get reported to your credit score. But if you legitimately made a mistake, you know, you kind of just have to eat that. But if they made a mistake, you need to contact them to fix it, because it can seriously impact you down the line. Make sure that you're paying everything on time and reduce your credit card debt if you can. Other things is, you know, you can add people to certain accounts to help them build credit, you know, as authorized users on credit cards and things like that. So just kind of navigate that space and see what you're comfortable with, but know that you can rebuild them, they can go up. And so that may be something of looking at your credit scores, seeing that they're a little low, making a commitment to change that within the next year or two, and then after a year or two, looking at buying again. I mentioned your debt to income ratio, your DTI, a couple times, but again, the lower your debt to income ratio, the better. So this is looking at, again, your total debt per month versus your gross income per month. So generally, lenders are looking for your total monthly debts, including this mortgage, right? So they're looking to the future to see, okay, you're roughly going to have to, you know, pay this much for this house, to be no more than 43% of your gross monthly income. So they're looking at all those things. They're looking at your gross monthly income before taxes, and they're trying to make that informed decision. So again, if your total monthly debts end up being $2,400 and your gross monthly income is $6,000, you're looking at a 40% debt to income ratio. That is the best way to navigate it yourself. Again, kind of try and map that out if you can ahead of time, so you know going into it and you're not surprised. And then how much you can afford. I highly recommend getting a pre-approval from a lender. So as soon as you want to start kind of investigating this process, you can go to mortgage lenders. Some banks also offer mortgages, things like that. Get in touch with them and see how much you're pre-approved for. So they're going to look at all of these different things for you. So you can kind of go into it with a little bit more information as far as knowing your credit score and your debt to income ratio and all of that. But you can also get in touch with the lender, and then they'll ask you for all of the information that they need to make those decisions. So you're going to probably have to provide them with your 2 most recent pay stubs, at least 2 months worth of bank statements, your last 2 tax returns, and some W-2 statements. And so all of those different things they will compile to see, you know, if your bank account has been relatively stable, if you are receiving a paycheck, you know, consistently, how much that paycheck is for, all of those different things. So that way they can make at least an estimate of what you would be approved for. And so once they take all that into account, they'll essentially give you a pre-approval or a pre-qualification letter that is going to tell you how much you could get a loan for with them. And so that then gives you a really good budget and a really good basis to start your home search. You know, if they're looking at all of your things and they're saying, we would give you a loan up to $200,000, you now know that you cannot look for a $500,000 house because you will not be approved for that. You will only be approved for $200,000. It's just a really good way to kind of map out what is coming down the line. When you're thinking about your monthly mortgage, remember PITIA or PITIA, however you want to pronounce it. But really you're looking at your principal, your interest, your taxes, your insurance, and your association fees. So we kind of already went over principal. That's just the amount that you still owe on your mortgage loan. Your interest, again, I said it before, but in the early years of your loan, you're probably going to be paying more interest than principal. And so keep that in mind, try and get a low interest rate. We'll talk about that in a little bit. And then keep in mind your taxes, your school taxes, occupancy taxes. Again, they're usually built into your escrow account, as well as your insurance. Your insurance payment is usually going to be tied into your escrow. So you're really looking at all of those things in your monthly mortgage right off the bat. But then you may also have association fees. So as you're looking at properties, check in to see if they belong to an HOA, a homeowners association, and how much the fees are. So my property is in an HOA. I do pay a monthly fee to my homeowners association. My fee is relatively low. I know some places that have a very significant HOA. And so just keep those things in mind as you're looking at properties, because some of them can be, you know, $30, $50 a month. Some of them can be upwards of, you know, hundreds and hundreds of dollars. So look at that, know that before you commit to that, and know that you are going to have to pay that every month if you move into a property in a homeowners association. Usually those fees go to monthly upkeep and just general things. So sometimes they're higher in communities that have like a community pool or have a clubhouse or things like that. Other places, again, my property specifically is one of these places. Our homeowners association fee is really low, but this morning they plowed my driveway and everything, so I didn't have to worry about that. And so that's the kind of upkeep that it goes towards usually. So looking at our different types of mortgages, we have our conventional mortgage loans. These are the most common type, and they are housed by Freddie Mac or Fannie Mae. So if you've heard of them, that's why. They are giant mortgage lenders. They are very well known for this, and their down payments do range from 3% to 20% depending on your situation and buyer status. So I point that out because if you are a first-time home buyer, that means that you haven't bought a home in the last 3 years. So it's like a really interesting, if you bought a home 5 years ago and you sold it and you don't own a house right now, you would be considered a first-time home buyer again. But if this is your first property, you are looking more around that 3% range up to a 5% range. Usually, if you are somebody who's a little bit more seasoned or is buying a multi-unit property so that you can rent out multiple units, things like that, you're looking at a higher percentage down usually. So that's where you get into those 20%. You also, with your conventional mortgage loans, will likely need a higher credit score and a better debt to income ratio. So keep that in mind. If your credit score is awesome, if your debt to income ratio is awesome, you may want to go for one of these mortgages with Freddie Mac or Fannie Mae. One of the big benefits of doing that is usually you eliminate your payment mortgage insurance because you are paying it directly to them as opposed to paying it to a third party who's then paying it to them, if that makes sense. You then have non-conventional loans. So the most common non-conventional loan is your FHA loan. Your big pro of an FHA loan is the low down payment. So you can get a low down payment as low as 3.5%, and you may not need that stellar of a credit score. So that's where it becomes really beneficial. But as opposed to the conventional loan, you will have to pay that insurance premium for that loan, and that is for the life of the loan. So keeping that in mind as you're kind of navigating that, but it is a really good option for people who, again, don't have that 20% or may not be able to get the Freddie Mac or Fannie Mae because their credit score or their debt to income ratio isn't as good. The other types of mortgages are your VA loans. So they're guaranteed by the U.S. Department of Veterans Affairs, and it's only available for veterans and eligible active duty members, as well as their surviving spouses. So they require no down payment, they do not have a mortgage insurance fee, and they do not require a credit score. So if you are a veteran, if you are, if your partner is a veteran or active duty member, any of those situations, the VA loan is your way to go. You do not have really any negatives with getting a VA loan. The only negative with a VA loan is the restriction that it is for veterans or active duty members of the military. Similarly, your USDA loans have a lot of benefits because they don't require a down payment either, and but you do have to pay guaranteed fees for the life of the loan. So what that essentially means is kind of an insurance premium in a way, but not quite. And what the purpose of the USDA loan is, it is from the U.S. Department of Agriculture, and it is designed to promote people to live in more rural areas. So definitely check into it if you're looking at a more rural area to live in. For example, Gettysburg, if you live in the borough, definitely not a USDA loan. But if you live on the outskirts of Gettysburg and things like that, some areas do apply for USDA loans. So talk to your realtor, keep that in mind, because again, it's a really good option to take if it's available to you in the area that you're looking. You also do have to have a higher income for these, but again, you don't require a down payment and all those different things. So understanding interest rates, fixed versus adjustable, just keep these in mind, right? Interest is important. You may be well versed in it already at this point of your life, but fixed rates will stay the same. So your taxes and your insurance may change from year to year, but your monthly payments, if you have a fixed rate, will generally stay around the same. If you get an adjustable rate, it's more unpredictable because it goes with the market. So some years you may pay a 3% rate, some years you may pay a 6% rate, and that can make your payments month to month jump pretty significantly. So keep those things in mind. It's kind of like, do you want the steady or do you want to take the risk? The benefit of an adjustable rate, if you're only staying in a property for about 5 years, 6 years, a little bit more short term in the grand scheme of mortgages, is that all adjustable rates do have a fixed rate period at the beginning, which is usually like 4 to 5 years. and they do start you usually at a full point lower. So if you are mapping out that you might only be in your property for 5 years or so, you could go with an adjustable rate. And by time you're looking at that really big fluctuation, you probably will be moving and won't have to worry about it. So that's a really good benefit of adjustable rates. And again, your interest is based on IPAC, which is income, property, assets, and credit. So looking at your credit score, your assets are your savings. So any money that you have in your account, any big assets that you have, property. So if you're using this property as your primary residence, your rate is going to be lower because they trust that you're going to pay it more often since you actually live there. And then your income, the more you make, the less risky you seem. So the more likely they are to give you a lower rate. And just a quick overview of the process. I know we're coming up on time here, but step one, again, you're going to go seek that pre-approval. Step two, you're going to go house hunting. So based off of the pre-approval, you are going to look for properties within your budget or within that pre-approval rate. Find a realtor that you feel comfortable with and who has your best interest in mind. If you do not get along with a realtor, do not stick with them. There are some realtors out there that may just be really interested in the commission, may push you to buy a property that you're not completely sold on, all of those different things. So if you don't mesh well with your real estate agent, get a new one. That is so, so, so important. I cannot emphasize that because I literally cried to my real estate agent, and bless her heart, she was my best friend throughout this whole process. So make sure that you are getting a real estate agent that you trust, that you feel comfortable with, that you can just kind of have those moments of like, this is really overwhelming and I don't know what I'm doing. And so that's super important. Once you find a property that fits your budget, that meets all of the things that you really wanted it to meet, make an offer. You make an official offer. You may ask for it for lower than asking price. They may come back to you with some negotiations, but right now, candidly, the housing market is very hot. I'm sure you've all heard that. And you may get into a bidding war. So keep that in mind too of, you know, how much are you willing to pay for a property? Are you looking at a property that's lower than your pre-approval so you can kind of buffer, like all those different things. The next step is officially applying for your property. So you have to prepare a lot of documents again. So same way you did in the pre-approval, you're going to officially submit a bunch of documentation to your lender. And if your offer was accepted from that property, your lender will then review all of the documents that you've prepared, the official application that you're going to submit, and will give you a loan estimate. When they give you that loan estimate, make sure you review it all the time. You want to know all of the costs and risks associated with your loan. And if you agree to everything, you will need to like actually get in touch with them to say like, this looks good, let's continue on in this process. The next step after that is an inspection and appraisal. So you do need to get an inspection done for your property. That's going to look at any structural damage. That's going to look for leaks in your roofs and, you know, in your foundation. They will go so far as to, you know, check if your, you know, proposal said that they were going to include the washer and dryer. They'll make sure that the dryer works. They'll make sure that the washing machine works. So make sure you get an inspection. And then you're also going to need to get your property appraised. So this was a big shock point for me as well. But you are essentially getting your property appraised to see if the property is worth what the mortgage lender has basically said that they would give you. And so if it is appraised for less than that, your mortgage lender may say, oh, no, we're not going to give you the same amount of mortgage. We're going to give you less for your mortgage, and then you may have to make up that difference. So that's really important to keep in mind. If they approved you for $200,000, your house is now valued at $195,000, they're going to say, oh, well, then we'll approve you for $195,000, and you have to make up that $5,000 difference because you still made the offer for $200,000. And so that is just something to keep in mind. That leads to your conditional approval. So your mortgage lender is going to want a satisfactory appraisal and make those adjustments that I just talked about if they need to. And they're also going to, you know, if your house ends up in disarray and things like that, they also may change their approval based off of the results of the inspection. So keep that in mind as you are navigating that. And if all goes smoothly, you are then looking at your closing. So this is your final step where your lender is going to give you an official mortgage commitment that lets you know that it's firmly approved. This is how much money you're going to get. And then you then come about 3 days before your final closing meeting. You're going to have to pay all of those closing costs that we talked about a little bit before. And you're going to go through a huge stack of papers that signs the rights to the property and the mortgage and everything over to you and to any other purchasers. And that is your final step. At that point, you do own your house, which is really exciting. Again, just some things to not do. Don't apply for or take out any new credit cards or loans. So as I mentioned before, that can impact your credit score, the credit history, all of those different things. So you do not want to do that once you've started this process. Same thing, once you've started this process, don't make any large or unverifiable withdrawals or deposits to your account. If you take out $200,000 or $200,000, if you have $200,000 in your account, great. But if you take out $2,000 just because, and don't tell anybody why, or it doesn't go to anything specific, they will question that. They will question big purchases, things like that. And sometimes you do have to provide receipts and show what you were paying for, all of those different things. And then conversely, if you're getting a big amount deposited to your account, they're going to make sure that you're not receiving any other loans from any other resources. So your parents or a friend or whoever may give you a gift to help you with down payments or things like that. But they cannot just say, oh, well, I'll give you $5,000 now, but you have to pay me back. Your lender is going to make sure that that is not the situation. You're going to have to sign paperwork, all of those different things. Another big thing is not to quit or change your employment while you are in this process, because that's going to impact your pay stubs and your bank statement and all of that stuff. And then that is going to make you more risky, all of that. And then again, don't make an offer higher than what you were pre-approved or pre-qualified for, because you will have to make up that difference. And especially do not make a contractual offer. If you sign that paper, then you are obliged to fulfill it. And then you will put more stress on yourself because your mortgage lender isn't going to give you higher just because you did that. And the last thing I want you to keep in mind as you navigate either renting or property owning is your utilities. Are they included in your rent? A lot of places may include some. So some may include your trash and your water, but they might not include your heat and your electricity. Or are all of them on your own or anything like that? So again, sift through all of the documents before you commit to them so that you know what the expectation is. Are you responsible for paying for those? Keep them in mind. Once you are moving in, make sure that you're setting up your utilities. I had to stay with a friend right before we moved into our house because our electricity wasn't on. I just didn't think about it. And so they were able to turn our electricity on a Monday, but not a Sunday. And so I had to stay with a friend over the weekend because I didn't have electricity in my new house. So make sure you're calling before you move in to set up your electricity, to set up your water and all those different things. And then try and schedule for right after you move in those other things that you're really going to want, your internet, if you still have cable TV, your cable TV, all of those different pieces. And then just keep in mind, do your research about whatever area you're going to move into, because some places have vastly different costs for like the same thing. Water being one of them that kind of, again, was a shock to me personally, is I have city water because I live in a borough. I grew up with well water. So my parents never had a water bill growing up, things like that. But now I have this water bill that I have to pay, quarterly throughout the year. And, just being aware of that is really important. So that way you can map out, again, your budget month to month and know if your utilities are monthly, if they are quarterly. So a lot of, trash places, water places tend to charge every 3 months, so on and so forth. So make sure that you're very well aware of your utilities. And then your rainy day funds. So do not spend all of your savings to buy a house. Make sure that you still have savings There are a lot of expenses that are really big expenses when you break them down. And so don't spend all of your last dime on this property if you don't have kind of your rainy day funds. So that way, again, if your roof is leaking, you can repair it. If you have a big medical bill all of a sudden, you can take care of that. Your car breaks down, you can take care of that. Don't strap yourself so much for cash that you literally can't function. And then always make sure that you have a little money for you. Make sure that you're able to buy fun things, go on vacation, do all that stuff if you can. So don't strap yourself down too much. Make sure you always have some funds on the side. And so that is probably a lot of information for you all to take in, and I appreciate your attention throughout this. I hope it was helpful. If you have any questions for me, again, feel free to email me, stop by once we're all back on campus and, you know, able to kind of move around and all of that stuff. But feel free to email me, pcook@gettysburg.edu. I will try to answer your things as best as I can. But again, my recommendation, find a real estate agent that you absolutely love. They will help you so much. And don't be afraid to look up all of these things. Google, you know, areas that may apply for USDA loans. Google what, you know, what the situation is with utilities. Do all of that before you commit to anything, so that way you are well informed as you begin this process. Thank you so much. I hope you all have a wonderful rest of your break. And again, if you have any questions, let me know. But if not, have a good day.